Hello again, traders. Doing trading once again from Drfx, swing trading mentoring. Now in this video lesson, I'm going to be using this trade that was done on my live account on the pound Japanese yen, which provided a rate of return of 4.96%, to show you an example of how we confidently trade consolidation breakouts that take place in the currency market every week. So this is going to be using the techniques from the trading manual to show you how we go about identifying, first of all, the range consolidation setups that are formed in the currency market, the breakout signals that are provided when the market finally starts to break out either above resistance or below support, as well as the entry techniques and the placement of your stop loss and your trading targets so that you're able to stay in the trade and withstand temporary pullbacks and maximize on the trading gains provided by these breakouts ahead of sharp reversals so that you can remain profitable every time you trade these major consolidation breakouts. Now, the first thing that we need to do is to become familiar with the four main types of consolidation patterns that are formed in the currency market, both on the larger time frames as well as on the smaller time frames. Now, here you'll see on page 22 of the trading manual the four main types of consolidation setup that you will see being formed, with the most common one here being the range consolidation setup. This is where both the resistance and support boundaries are drawn horizontally. And then you have the three main types of pennant setups, where the resistance and support boundaries are formed at different angles to each other. So here we can see a situation in which both the resistance and the support boundaries are formed at 45-degree angles, whereas with these two, either the resistance or the support boundary is formed horizontally with the corresponding boundary being formed at a 45-degree angle. So these are the four main types of consolidation patterns, range setups, and three types of pennants that you will generally come across when trading the currency market every week. So it is very important to become familiar with these types of consolidations so that we can quickly spot them and prepare a trading plan to take advantage of the movements either between resistance and support, or when a breakout finally takes place either above resistance or below support. Now, this is very important when it comes to actually using the right technique in terms of identifying and drawing the boundaries of resistance and support. Now, what I found is that there are actually two ways in which traders and mentors actually teach in identifying and drawing these consolidation setups. The first one, which is the incorrect way, is where the wicks, the highs and the lows of these candles are ignored when drawing the boundaries of resistance and support. Now, I'm not exactly sure, but I believe that the reason is that they place very little emphasis on these wicks and place more emphasis on the bodies of the candles, and their belief is that this is more representative of the price action and the sideways movement that is taking place in the currency pair. However, by using this technique, you actually face the situation in which you can be caught out by the common market trap of false consolidation breakout reversals. Because what you'll find here is that if you see a breakout signal, if you use this technique of ignoring the wicks of the candles, you can actually come into a situation in which you see a breakout candle here, what looks to be a breakout candle, and be tempted to actually start a trade and enter the market short in anticipation of a breakout bearish. But what I found is that what the market actually responds to in actually providing us with the green light and the confirmation that the breakout is actually going to be taking place is when it actually breaks below these wicks that this technique ignores, right? So you have to ensure that the breakout candle surpasses these wicks when you're talking about a bearish breakout or a bullish breakout in order to confirm that we're actually starting a breakout from consolidation, because the market actually respects these wicks of these candles, right, as strong price points. And so it is only when the market breaches above and below these price points, these wicks, that we actually can ensure and get the confirmation that a breakout is actually going to be taking place. So with this technique, you can be caught out by these reversals, these sharp these false breakout reversals when the market actually takes us back inside of a consolidation, because it has not yet broken below these wicks, and so it is not yet ready to start a breakout. However, if you use a proper technique, which is to include rather these wicks, which are very important in terms of identifying price points and major pullback points, then you can see here that in that situation where you thought the market was actually breaking out, it was simply hitting the support point, and the probability of the market breaking out and rallying is still 50-50, right? Probably leaning more towards the bearish side because it would have been in the more recent price movement would have been bearish. But the possibility of the market rallying and continue to move within consolidation is still very high. The probability is still very high because we have not yet broken below these low points of these wicks. So this is very important when it comes to identifying consolidation, because using this technique will allow you to be in sync with what actually takes place in the market and what price action actually responds to when we're talking about movements with regards to consolidation setups. So these wicks, these high points, are actually obeyed by the market when it comes to determining whether we're going to see a strong breakout, either bullish or bearish. And so we need to use this approach and include these wicks when we're identifying and drawing these consolidation boundaries. So the next step will be to show you an example of how we identify these types of setups when it comes to trading in a real situation. And in this case, I'm going to be using the same trade on the pound Japanese yen to show you how I identify the range consolidation setup that was formed on the 4-hour chart. So let's take a look at the situation on the pound Japanese yen that was traded to show you how we go about identifying range consolidation setups. So the first thing that we need to do when we're looking at the chart is to clean the chart and identify any obvious points and any obvious areas of sideways movement that has been taking place over the last several days. So you can see by this area here, that the market has been moving sideways in this area, in this region. So having identified this sideways pattern, the next thing that we do is to identify the points of resistance and support. So we go ahead and we identify the first point of resistance, which you can see was formed here. The market then moved bearish and then rallied, U-turn here to form the first support point. After rallying, it then U-turned once more to move bearish, and in so doing provide us with this second resistance point. And then in moving bearish and rallying once more, it then U-turned to provide us with the second support point. And once again, after rallying, it then provided us with this third U-turn area here to provide us with a third resistance point that would form the consolidation setup. So the next technique or the next step would be to use these points of resistance and support and identify whether or not the market would actually be forming a range setup or a pennant setup, depending on the angle of the line that we would draw across these resistance and support points. So the resistance boundary would clearly be a horizontal boundary, and using the same technique to the support area, we would see that the support boundary would also be horizontal when we connect these two support points. Alright, so this is generally the approach that we use in identifying consolidation setups when the market has been moving in a sideways pattern. So the next step is to use our line and connect these points of resistance here, where we include the wicks of the candles, and then we get the corresponding support boundary where we also include the wicks of the candles here. So this was the range setup that was formed, that was traded bullish when the market finally broke out above the resistance boundary, and it shows you the best technique that the market actually responds to whenever we're drawing boundaries of resistance and support when identifying consolidation patterns. So the main goal of this video lesson was to show you how we go about identifying the points of resistance and support in order to be able to accurately identify and draw range consolidation setups, which is one of the 4 main types of consolidation setups that we see in the currency market. The next set of video lessons will use this trade on the pound Japanese yen to show you how we go about identifying the main types of breakout signals when the market is ready to break out either above resistance or below support. And I'm also going to be using this trade along with the trading manual to show you the techniques of entry, stop loss placement, so that you are able to stay in the trade and withstand temporary pullbacks until your trading target is hit, and speak to the trading target and how we set them when it comes to consolidation breakouts, so we can maximize on the trades that the pips that are provided by these breakouts and exit just before the market reverses when these breakouts finally end.